Well, my next guest has been bullish and has expressed awe at the resolve of the economy and the stock market. But does he still feel strong like bull? Let's find out. Kobeissi letter editor-in-chief Adam Kobeissi is with us. Adam, you posted this long tweet, but I think it's amazing because you've got the key financial events for this year. The mortgage rates at 7.2%. We see credit card debt going, for $1 trillion for the first time. Regional bank crisis, the dollar coming down, Fed interest rates to the highest level since 2001, the debt ceiling crisis. You got it all down here. Bankruptcies erupting, interest rates obviously $1 trillion. That's going to cost our country. The Fitch downgrade. Here's the key, and yet the S&P is up an incredible 700 points this year. The most resilient stock market in history. You have a question mark there.
Yep.
Is it the most resilient, or are you questioning whether it can stay the most resilient?
We think it really is. I mean, we've been bullish for the majority of this year. We've been on the show many times and calling every time we're raising our S&P target. Now it's the same story again. I mean, you saw yesterday Fitch downgraded the U.S. credit rating. In 2011, this led to like a 20% drop. I mean, it was a completely different setup back then, of course. But right now, today, we're 1 to 2% off the 52-week highs. And again, it looks like the dip's going to be bought. The market sentiment is strong, and people are looking to buy.
Most of the things that you have here, they're bubbling, right? So the most bankruptcies, this is just starting, right? The interest rates over $1 trillion, that's going to continue, right? The Fitch downgrade, I don't know if their competitors will do the same. Mortgage rates may go higher. Credit card debt's going to go higher, more than $1 trillion. So all of these things, we may have averted something here with the credit thing, but all of these things are still bubbling up. Is there a point where you say, okay, I'm a little worried?
Yeah, I mean, it's like the regional bank crisis. Something broke, and then the Fed adjusted, and then nobody really knew if it was going to keep breaking or not. Right now, it's so hard to call, a complete top or something to completely break with the momentum that markets have had. I think right now, you just can't fight this market, and the trend really is your friend. I mean, I know it's an age-old saying, but if you would have tried to call a top at any point this year, you're already underperforming the S&P, and we're pushing new highs, and we think you could even see new all-time highs. Does that mean that in a year from now, 2 years from now, there could be some credit event or some sort of bubble that forms? Absolutely. But for the foreseeable future,
we'll take it if it's a year or 2 years.
Yeah, we're not too worried for the rest of this year.
And the point you just made about calling the top, there's so many firms that were negative. I mean, for the most part, Wall Street was negative. Over the last 2 weeks, they're throwing in the towel. So J.P. Morgan, their main strategist is still bearish, right? He's going to hold on to that Kalanovic. But their trading desk is like, you know what? To your point, all systems go. S&P 5,000 easy.
Yeah, well, I mean, and the other thing is, this market is being driven a lot by those people that were, everyone was bearish. Now it feels like a lot of people are bullish, but even still, there's still a lot of bears. And bull markets, especially the start of a bull market, they're driven by capitulation of bears, just covering shorts, having to buy back those shorts. And in itself has added at least a few hundred points to the S&P this year.
I got to ask you about the bond market, because you were bullish on the bond market. We did get a nice move in the beginning of the month. We're coming down. Look at that. That's a huge move down on TLT. You stand with bonds?
So we've been bullish, and this has been kind of a weaker trade. I think it's a tough situation right now because prior to the Fitch decision yesterday, TLT was starting to form a bottom right around the 99 to 100 level. Now we're back down again. I mean, this is really a call on our part in the next 6 months that the Fed's going to be less hawkish than expected. And I think TLT is still looking pretty cheap right now.
So this would be the ultimate buying opportunity if you're right.
I think if the Fed will pivot and start pausing and ultimately cutting rates like we're expecting, TLT will be great.
I got 30 seconds. I'm sorry to interrupt, but tell me what you're most concerned about.
I think right now we're most concerned about just the Fed overdoing things. I think right now it's like the forecasts are up and down, and we think, like I just said, the right route is to pause and stop raising and then start cutting into 2024. Just wait and see what happens. Inflation data is going to come out, jobs data is going to come out. No need to jump the gun. I think if the Fed really starts jumping the gun and get ahead of themselves too much, we could push ourselves into some sort of a credit event or,
One thing I really love about what you've done is that you've followed, you've let the market dictate. You haven't dictated to the market. And I think that's brilliant. So many of these smart folks have been around for a long time. It's their work, and they ignore what the market is screaming at them.
And I always say the market is never wrong. You're just right or wrong. You have to play the market you have.
All right, Adam. Thanks a lot.